When most people come to me as a financial planner and tax advisor, they don't want or even need life insurance. What they want is liquidity, safety, a decent rate of return, and tax-free access to their money when they want it. After I show them several options, most of my clients do exactly what I do with my money. They choose a properly structured, investment-grade life insurance contract designed to provide them with safety, liquidity, rate of return, and tax-free access to their money when they need it. Many of my clients choose to pull money out of their IRA or 401k to invest in the indexed universal life insurance contract, or they may simply stop contributing to their IRA or 401k and invest in the life policy instead. Some will choose to invest in the indexed universal life contract by moving their money from home equity and into the IUL. Some simply decide to invest on a monthly basis from their checking or savings accounts. Regardless of how the product is funded, most of my clients feel that it is the best wealth creation tool they have ever seen and wish they had gotten involved sooner. Although most Americans do not view cash value life insurance as a tool for creating wealth and legacies, this concept has been around for over 100 years. In the 1950s, Walt Disney dreamed of opening an amusement park filled with great rides and great food. Everyone told him it couldn't be done, especially since he wanted to build the theme park in Orlando, Florida, which was mostly swampland at the time. He was turned down by bank after bank after bank, so he used the cash value in his own insurance policy to finance the project. Disneyland opened in 1955 and has been a tremendous success for over 50 years. In 1955, Ray Kroc opened the first McDonald's restaurant. He struggled with cash flow and needed additional funds to stay in business. Having already drained his savings account and borrowed all he could from friends and family, he turned to the cash value in his insurance policy to get the business off the ground. Today, McDonald's is a global icon with more than 25,000 stores worldwide. During the Great Depression, JCPenney stores almost went out of business. The only source of financing available to the company was the company's owner, James Cash Penney, and the life insurance policy that he held. He used the cash value in the policy to cover day-to-day costs of keeping the business open and to meet the company's payroll expenses. Finally, when Leland Stanford, the governor of California, lost his son to typhoid fever in 1868, he decided to honor his son's memory by opening Leland Stanford University, today known as Stanford University. To keep the struggling school open, the family used the cash value from a life insurance policy to help fund day-to-day operations and to pay the school's faculty. Let's take a look at how this wealth creation tool works in the lives of our typical client. What I want to do now is run through an example to demonstrate the way the product works to create multi-generational wealth. Meet Anthony and Michelle Cruz and their baby boy, Nathaniel. They're both 45 years old, in average health, and can afford to invest about $500 per month to build their family legacy. Anthony and Michelle are looking for solid, steady returns on their money, protection from market losses, and guaranteed income when they're ready to retire. They would also like to build a legacy to leave to their children once they're gone. To satisfy their needs, we put together 2 indexed universal life policies with a death benefit, which I call a legacy, of $300,000 for each spouse, which Michelle and Anthony plan to hand down to their children and grandchildren once they pass away. These indexed universal life policies offer them safety of principal, liquidity, an excellent rate of return, as well as tax-free access to their money in the form of a guaranteed income for life. The policy also offers valuable living benefits in the form of terminal illness, chronic illness, and critical illness riders. These riders provide coverage for the family in the event that they become injured, ill, involved in an accident, suffer a heart attack, stroke, diagnosis of cancer, etc. 1 year after the policy is issued, Nathaniel suffers a heart attack, but does not pass away. The family takes $65,000 out of his legacy, or face amount. Note, even though Anthony has only paid in about $6,000 into the policy, he is able to access the full $65,000 because he suffered a heart attack. With that $65,000, Anthony and Michelle pay some medical bills. They make a down payment on a new home, and because they see the value in the Indexed Universal Life policy, they invest $25,000 in an Indexed Universal Life policy for their son Nathaniel. When Nathaniel was ready to go off to college, Anthony and Michelle used the cash value in their policies to help fund his education. They access $5,000 per year for 4 years to cover the cost of meals, books, room and board, etc. At the age of 65, the couple is finally ready to retire. They have a combined cash value of $500,000. They are able to enjoy a guaranteed, tax-free income of $50,000 per year, every year for the rest of their lives. Now, the average American has less than $60,000 saved for retirement. This couple has nearly 10 times that amount. Additionally, their income will be paid to them on a tax-free basis. This means that their retirement dollars will go much farther for them and last much longer. 20 years into their retirement, Anthony is diagnosed with congestive heart failure and is said to have 2 years or less to live. Because he is diagnosed with a terminal illness, he can access a portion of his legacy while he is still alive. His legacy, or death benefit, has grown to over $65,000, and he elects to access $235,000, and with that money, he makes an outright gift of $150,000 in cash to his son Nathaniel. A few years later, Anthony and Michelle both pass away. The remaining legacy is now over $600,000. They make an outright gift of $500,000 to their grandson William and invest $130,000 into 2 policies, indexed universal life policies, for each of their 2 great-grandchildren. Let's take a look at Nathaniel's policy and how it has grown over the years. He has an indexed universal life insurance contract just like his parents. He has a $500,000 death benefit, or legacy, which he intends to leave for future generations of his family. You'll recall that Anthony and Michelle made a lump sum contribution to Nathaniel's indexed universal life contract when he was a child. They contributed $25,000 and just let it grow, with no further cash investments. By the time Nathaniel is 35 years old, he can start to receive an annual income of $35,000 completely tax-free. This $35,000 annual income will be paid to him every single year until he reaches the age of 65, where the annual tax-free income will increase to $200,000 per year for the remainder of his life. If he lives to reach age 100, Nathaniel will have received over $8 million in tax-free income, tax-free guaranteed income, no matter what happens with the stock market, no matter what his choices are in life. When Nathaniel passes away at age 100, his legacy will have grown to over $9 million. He will also have $8 million in cash value. When he passes away, those amounts are left for his children and his children's children, and the wealth cycle starts all over again. So let's look at the multi-generational benefit summary enjoyed by this family. During the course of their lifetimes, Michelle and Anthony received living benefits of more than $577,000. When they passed away, the legacy they left behind was over $1 million. Nathaniel received over $8 million in tax-free income during his lifetime in the process of building your family legacy. The key to becoming wealthy is not the level of your income, but the ownership of income-producing assets. Of all the possible asset choices, the Indexed Universal Life Contract is the only one that provides safety, liquidity, a good rate of return, and tax-free income for life, combined with living benefits to protect you in the case of serious illness, injury, or old age.